All right. So does investing in index fund in a way get you better returns than markets and also control the downside? Well, there is an answer for that, and factor investing seems to be the right answer for it. Factor investing is actually choosing investment based on specific criteria that are known to impact portfolio performance. Some of the most famous factors are quality, value, size, momentum, and low volatility. So let's begin the show and let's focus on factor investing, because today a lot of AMCs we are seeing are coming up with index-based factor investing. So let's understand all of this and let's welcome on board Feroze Azeez, Deputy CEO, Anand Rathi Wealth. Feroze, good evening and welcome to the show. Factor investing, I think that's something investors are very keen on knowing. But then before that, let's get on to the aspect of factor investing, and later on we'll also help our viewers understand the criteria based on which they can select what type of factor investing they should be focusing on. But why the need of this kind of strategy? And historically, if I may want to understand, how has this investing style really helped investors?
Good evening, Kavita. It's an apt topic because factor investing helps a person understand what are the factors which a fund manager uses to pick a stock. Now, if you standardize those factors and make it non-human judgment, that becomes a factor index. These are factors which a fund manager applies and then uses his subjectivity in a normal active fund. If I can just standardize that and make it as mathematical as it could get, then it becomes a factor index. Firstly, if you look at index funds in India, how they're constructed, or mostly globally also they're constructed, which are generally growth stocks, get larger weightage. That's a big fallacy. Now, for example, if the largest stock of Nifty is HDFC, if HDFC does very well as a bank, then the weightage automatically goes up. So the better the stock performs, the more the weightage it gets, more the weightage it gets, more the amount it gets, and more the amount it gets, more the price moves. So it becomes a vicious cycle. So most of the indices created are on growth stocks, growth concept. So it becomes very difficult to actually have a spiraling upwards or downwards. So factor investing brings some better signs than a conventional index fund. And that's why you would see last year, out of the 48 index funds launched, 41 were unconventional, non-conventional, and only 8 were conventional index funds which got launched in the industry.
All right, so let's talk about the elements involved over here, Feroze, and let's take our viewers one by one on it.
Yes, so if I go step by step, see,
Yeah.
value is contrary to the growth way indices are constructed, largely globally and more so in India. Now, if there's a value stock, it's not going to, because it's not run up in the past, it will not get its due credit in an index like a Nifty stock, a Nifty index. So value is the opposite of growth. So factor investing mein value becomes one of the most important criteria, where the indices actually index chooses the value stocks, in the sense lower price to earning multiple, lower price to book multiple, lower price earnings to growth ratios as well, PEG ratio as they call. These are the large 3 valuation parameters. Lower the valuation, the better it is, and it can find its place in the value index. That's one. Then you have dividend yield, Kavita. Dividend yield is where you're buying stocks which throw up a lot of cash flow. See, like if you look at several PSU companies where they had a large dividend outflow, so dividends in certain years had become as high as 6% of the price of the stocks. So that's a dividend yield concept. You bring those group of stocks which are higher dividend yield. Like Nifty companies have 1% dividend yield weighted average, give or take. That means if the price is 100 rupees, the dividend is just 1 rupee. That's 1% dividend. So if you garner those stocks which have larger than 1%, 2%, 3% kind of dividend yield, especially given in a mutual fund, the dividends are tax-free to the fund because it's a trust format, unlike an individual. So I'll stop here and then probably go into the next concept as you guide me.
Sure, but then the kind of key indicators that you have we've just discussed, and you've just explained the key factors that that are included in factor investing. How can an investor decide which is the right factor for them, and how do we look at these strategies in a fund? Maybe you just might want to explain this by giving a fund's example that represents factor investing.
Yes, Kavita. See, I think when it comes to factor investing, a person should be very clear of the contemporary situation. Now, for example, 2 years back, value as a concept was languishing, and there was some degree of mean reversion possible.
If you like this video, then like, share and subscribe to ET Now.